Welcome to the InterMarket Analysis video update. This is a video that I do once a week. I do videos every day, and then, of course, every week I do a weekly video, and then I also do another weekly video called this InterMarket Analysis video update, where we look at markets outside of the S&P 500, and we also look at other sectors and even other markets because no market exists in a vacuum. And sometimes what's going on in the bond market or what's happening with gold or what's happening with commodities can have an impact on what's happening in the stock market in general and then the S&P 500 in particular. This is being prepared for Monday, November 13th. The first area that we look at is valuation, and that's just within the S&P 500, although we do look at some other indexes. We look at this in a number of different ways. We look at historical reports that have come out, earnings from companies, and compare them to what their price was at that time for the stock. And then we look at the future forecasts or what analysts come up with for projections to see, okay, where is the market at right now? Is it considered expensive? Is it fairly valued, or is it cheap? The first area that we look at is by looking back. And if you hear a cat in the background, he says hello. We have static numbers for a thing called the PE ratio, the price to earnings ratio. This measures what's the price in relation to the earnings that have been reported. And these static numbers are 10, 15, and 20. If we're 10 or below, we're considered to be inexpensive or cheap. If we're between 11 and 19, that's considered to be fairly priced. And 20 and above is considered to be expensive. Well, looking at this chart, we have them all plotted out here in red, blue, and green. And then I have the S&P 500 on this chart as well. You can see that we're well above the PE ratio of 20. And we've been that way for quite a while now. We don't necessarily use this to make day in and day out decisions. This just tells us the overall status of the market on a valuation basis. Just something that is helpful to know that we can use and tuck it back in our minds. And then we also down below compare the current price to the PE of 20. Whenever we're above 0 and going up, that means that we are expensive. So looking backwards here, the market right now continues to be expensive. Then we can also plot this with different historical events that have happened and what the valuations were at that time. And then we also have another thing called the Shiller PE ratio, developed by Robert Shiller. This takes more of an average over a period of time with earnings to price, and we're currently coming in at 29.89. Well, to give us some context, we have a historical chart here. We can see that we're just about at the point where we were back in 1929. We're well above the point where we were back in 1987 before the big crash. Also, to give us a little bit more context, we look at the median and the mean, and we're just under 16 and just above 17. Well, our current reading right now is 29.89. So historically, stocks continue to be, especially the S&P 500, overvalued. But this has gone on for quite a while. So we don't necessarily freak out about it. We just want to be aware of this. However, the market doesn't do that. They look forward. They look at what analysts are projecting earnings will be going into the future and then base a PE ratio on that. And as of Friday's close for the S&P, we're coming in at 18.3. We still use the static scale of 10, 15, 20. So we're under 20, but we're above 15. To give a little bit more context, we also look at the mid caps, and we're coming in at 12.8. We're under 15, but above 10. And the small caps, which have really been under a lot of pressure lately, they're coming in at 11.9. So we're above 10, but below the 15 level. So that gives us some context as to why does the market even want to go up from here? Well, looking forward, the market is not necessarily overvalued, where if you look past at historical earnings reports that have come out, yes, the market is overvalued. We can plot all of this on the same chart where we have the S&P 500, the mid caps and the small caps in different colors, and they really correlate with each other. They tend to go in the same general direction, just to give us some context. Now, when we're looking at the small caps, we look at two different indexes. There's the S&P 600 index, that's for the small caps, and that's the blue area, and that lines up with the 10, 15, 20 scale that we use when we're talking about valuation. Another very popular small cap index is the Russell 2000, and that's in red, and that's on a slightly different scale. So for that, we don't really use that as part of our valuation process, but we just want to be aware of the subtle differences between the two. Another area that we look at is growth versus value. When the market's really going up, you want to buy low and sell high and produce some capital gains. Those are growth stocks. Well, other times when the market runs into trouble, or maybe you're more of a conservative investor and you want to get into things that maybe pay dividends, or if we hit some difficult times in the market, it may go down, but it won't go down as much as growth stocks. You might get into some value areas. So first of all, we look at the growth index, and this is starting to come in a downtrend. We saw a recent death cross here, so it is going down. We also look at a value index, which is also in a downtrend, but it's in a more pronounced downtrend. Where this really becomes useful is when we look at them together and take a ratio. Where in the top part of this chart, we have the growth to value ratio and shows that growth is outperforming value, even though both of them are in downtrends. On the bottom, we see where value is underperforming growth. The reason why I have a lot of different charts and then charts after this to show you is that we look at indexes, ETFs, different sectors, and so forth, and all of them calculate just a little bit differently. And so we want to make sure that we're seeing the same things at the same time. You can see here where this moving average crossover, it occurred at a slightly different time. And if you make a decision based on this, it's like, wait a minute, this is crossing over, but this one's not. Maybe we need some more confirmation. We also look at growth to value ETFs and do a ratio, and this is showing that growth is outperforming. We take an inverse of that same chart showing how value is underperforming. And then we look at another index showing how growth is outperforming, and it fell back recently, but it's starting to come back a little bit. And then we look at value to growth, where it shows that growth is underperforming or growth is outperforming, however you want to say that. We also look at some different indexes. This is showing where growth is outperforming. Then we have some different measurements, some different ETFs that we use here, and this is also showing that growth is outperforming. I've been using this the last few days in the daily videos because even though we were going sideways for the first 3 days of the week and we had a down day and then an up day, growth has been holding up fairly well. And it did partake in the big upward move that we saw a week ago. Here's value to growth, showing how value is underperforming. And then we look at small caps. We look at the growth to value ratio. And even though the small caps have been under a lot of pressure, if you just look at the index, so far the ratio between growth to value, it's hanging in there fairly well. It's chopping sideways for the most part, but it's still in a longer term uptrend. And then we look at mid-cap growth to value. And I've been showing this the last few days in the daily videos, where even though the index itself has been under a lot of pressure, and then we saw that monster upward move, well, this has been hanging in there. It's not necessarily breaking out yet, but it is actually showing a little bit of strength. It has been going mostly sideways for the last few months, but overall, it's still in an uptrend. Then this is the one that I focus on the most because I focus on the S&P 500. This is the growth to value ratio, where this is a little bit of a concern, where we've been going back up with the index. The growth to value ratio has actually been going down. And so this is a little bit of a warning sign. We want to see growth really kick into gear and outperform value if that's going to help the indexes to move higher. We also keep an eye on inflation. On top is a monthly chart of the CRB index. These are commodities, where it's still in an uptrend, but it has been seeing some weakness as stocks have been rebounding. And then we take a ratio between inflationary parts of the CRB index and deflationary parts and look at that. And when this is going down, that means that inflation is going down and deflation is actually outperforming inflation, which can be good until it gets to the point where, okay, that's really happening, because even though inflation is bad, deflation, believe it or not, is even worse. People think, oh, prices are going to fall. I like that. Well, the damage that it can do to an economy is pretty phenomenal. But for the most part, inflation is what the markets are fixated on. And as long as this continues to go down without really moving fast, the more positive that is. We look at the CRB index all by itself, where it is in an uptrend, but it has been seeing some recent weakness. We look at the Baltic Dry Index, and there are people out there, I learned about this from somebody else by reading an article. There are people that shift it forward and put the S&P 500 a little bit behind or ahead or what have you. I don't do that. I just look at what is the Baltic Dry Index telling us right now, and then up on top is the S&P 500, where we are going more in an uptrend. Now, what's this measures is how much does it cost to ship products from one place to another, specifically in the Baltics. And when it costs more, they're going to have to pass that on to consumers. And so it's going to cost them more. And that's inflationary. So when this is going up, that's a little bit of a concern after it had been really declining. Some other markets, and we don't trade these markets. I just look at these markets just in case they're really going crazy. We just want to keep an eye on them. The first area is aluminum, and this is continuing to be in a downtrend. Corn, also in a downtrend. Wheat is in a downtrend. Look at fertilizer. That's a pretty important thing for growing things. Where it had been coming down, it was coming back up a little bit, but lately has been chopping sideways. Oil, this really impacts all of us, where it's starting to go back into an uptrend, even though it's pulling back. We were up into the 95 range, and now we've come back down into the 77 range. And this was more inflationary because earlier in the year, Saudi Arabia and Russia said they were going to cut back on production. The market didn't like that. And then they decided to extend that cutback in production. And that's when we saw oil really going up. Well, that seems to be subsiding a little bit now. So oil has been coming down. But we have a lot of unrest right now in the Middle East. And that is where a lot of the oil comes from. And so this could turn and go back up, but for right now, it's continuing to decline. Gas, this is something that influences all of us. It's actually in a downtrend. And then we look at diesel. This is what trucks and 18-wheelers use to move products from place to place, where it had been coming back up, and now it's starting to come back down. Heating oil, starting to get cold now, and we're in a longer-term uptrend, even though this has been pulling back. Natural gas, another big source of energy. This is starting to go into a new uptrend here after it really had been declining. Copper, this is a barometer of the economy. When copper's doing better, generally the economy is looking more rosy going into the future. When copper's having some problems, that's when we're seeing some problems in the economy. And a few weeks ago, we did have a death cross here with copper, and it's now in a downtrend. We also like to look at gold, and we take a copper to gold ratio. When things are looking better economically, this ratio will be going up. When things are not looking as strong economically, this ratio will be going down, and that's what it's doing right now. Gold is actually outperforming copper. We have a longer-term chart of that same thing, where the black line is the copper to gold ratio going back to 1980, and you can see how it performed. And then plotted on here as well is the 2-year yield in green and the 10-year yield in red. And typically for the last decade or so, these have had a tendency to go in the same direction and not get too far apart from each other, even though they're on different scales. But for the last couple of years, we've been seeing a real divergence here, where the copper to gold ratio is going down as interest rates are going up. So this is telling us longer term that there's a real shift coming in the economy based on this chart. We also keep an eye on gold, which started to break out as unrest was happening in Israel. And now that they're dropping out of the main news cycle, we see gold starting to pull back, even though it's still in a longer-term downtrend here. The blue line crossed below the red line, and you've got a lot of people that just love gold, and they can justify anything that gold does. Even though it hasn't really broken out from these previous highs, they think it's just around the corner, and then eventually gold's going to go to the moon. Now, that may end up happening, but we are seeing some recent weakness here. There's also a lot of folks that are in the silver market as well. This is also in a downtrend. It was starting to really bounce back up as well as there was political and geopolitical unrest, but now that's starting to pull back as well. Then we look at gold on the top, and this is just the closing values where it's been coming down lately. Then in the middle, we have silver, and then on the bottom is a correlation. And it only stands to reason that gold and silver tend to go in the same direction at the same time. And that's pretty much true. You can see the correlation. When this is going up, that means they are moving in the same direction. It doesn't measure direction itself. It just measures, are they going in the same direction? And so now you can look at a chart and actually quantify this and qualify this by just saying, yeah, gold and silver tend to move in the same direction for the most part. Then we have another study here. We get some general rules from this. Up on top is the gold to silver ratio. When this is going up, gold is outperforming. When this is going down, silver is outperforming. Then in the middle, we have the dollar index. And when it's going up and down, and we've seen some recent strength in the dollar. Some general observations that we can make is that when this is going up, gold tends to outperform silver. When this is going down, silver outperforms gold. Now, they both can be going up or down at the same time, but this, if you like to switch back and forth between the gold and silver market, this can be kind of a useful tool. But if you look at the bottom, you can see where we typically have a high correlation between the top chart and the middle chart. It's starting to go back down into neutral now. So we're seeing a little bit of a divergence here. The dollar index continues to be in an uptrend, even though it was down in Friday's session. It has been rather strong lately. And then we look at the euro on top, which is in a downtrend compared to the dollar. And then in the bottom area is the dollar index. Then we have the Japanese yen, which has been going down compared to the dollar, as is the euro, and then the dollar index on the bottom. And then this is just a standalone chart of the euro to the US dollar. You planning on going to Europe? You'll probably get a more favorable exchange rate as the euro has been coming down and the dollar has been going back up. So it's in a downtrend. We also keep an eye on the Japanese yen. You want to go to Japan, you'll get a much more favorable exchange rate because the Japanese yen is in a downtrend compared to the dollar. And you want to go to England? Yeah, it's also in a downtrend. We've seen a recent death cross here. We've been chopping more or less sideways, but overall it has been declining. Some index ratios. We look at the S&P 500, which is a weighted index, meaning that the really big companies, they have more of an impact on the S&P 500 going up or down. Then there's another type of index called an equal weight index, where all of the stocks in the S&P 500 are treated the same. Well, when this red line is underneath this black bar chart here, that means that the broader market is underperforming the rest of the market. Now, they are on slightly different scales. But when we're looking more positive, we want to see both of these going up and sometimes even seeing the red line outperforming the black bar chart. Lately, the red line has been underperforming the S&P 500. It did tick back up in Friday's session, but we're seeing this really underperforming as it's really just a small number of really big stocks that are really influencing the markets right now, the big mega caps. We look at a ratio between the S&P 500 and the CRB index. So we're looking at stocks versus commodities. And we're actually showing that this is in a death cross here recently, but it is starting to go back up. Now, if we can stay above both of these moving averages, eventually we'll see a golden cross here. Here's an inverse of that same chart where it's showing that commodities have been outperforming stocks, but it's starting to come back up slightly. We look at the NASDAQ 100, which is pretty much all tech and really big tech companies, and compare that with the S&P 500, which does have NASDAQ 100s in it. But it's probably not a surprise, especially in 2023, that the NASDAQ 100 continues to really outperform the S&P 500, even though they both have had very good years thus far. The S&P 100 is outperforming the S&P 500. The 100 stocks are the biggest ones in the S&P 500. And then we look at the NASDAQ to the S&P 500, where we're going sideways for the most part, but the NASDAQ is still continuing to outperform the S&P. We look at the NASDAQ 100, which has been doing well, and the NASDAQ, which has been doing well, and the NASDAQ 100 is really outperforming. This also suggests that the big mega caps are outperforming the rest of the market. We look at the mega cap ETF and compare it with the equal weight ratio, and it's showing that the mega caps are really outperforming. We also do a ratio between the S&P 500 and the small caps. The ratio is the red line. And when this is going down, that means small caps are underperforming. And that's not what we want to see in a positive environment. Now, we have interest rates going up, and a lot of smaller companies, they need to borrow a lot. So rising interest rates can really affect them. And that's one reason why they've been going down. But in a good, healthy environment, we want to see this red line going up as the blue line, which is the S&P, continues to go up. But that's just not happening right now. Here's another ratio where we look at small caps compared to the S&P, and they are really underperforming. That's a warning sign. It's something to be aware of. We look at the 30 biggest software companies, where just recently we saw a death cross here, but lately they have been bouncing back. The mega caps, these are the big monster companies. They're continuing to do quite well. Even though they pulled back, they have seen a real resurgence lately, and they're still in an uptrend. We look at robotics and AI. That's kind of the craze right now, but the ETF is not doing all that well. It's actually been underperforming. It's bounced back a little bit here, but what's really interesting is when we compare it to the tech sector, it's continuing to really underperform. The Dow Jones Composite Average. It takes the Dow, the transports, and the utilities and puts them together in one measurement. And it's been chopping more or less sideways, but lately we saw a death cross here. If we can get back above this, that would turn this more positive, but for right now, it's looking more negative. Then we look at the S&P 500 and compare it with shorter term bonds from 1 to 3 years. And it had been really underperforming, but over the last week to week and a half, it has been starting to make a comeback. We look at a broad market of stocks and then compare it to further out bonds, and this is also showing a bit of a rebound here. We look at low volatility stocks, which held up a lot better in 2022. They haven't been doing as well in 2023, and they continue to be in a downtrend. We look at a ratio between low volatility stocks and the S&P, and this is continuing to go down. We're coming down to previous lows here. We're wondering if this will end up providing some kind of support with this ratio, or are we going to continue to fall? Then we look at the tech sector and compare it with further out bonds, 3 to 7 years, and it just shows that tech is really outperforming bonds. Then we look at the S&P with some other stocks. This is an advanced decline line study across the market. On top is the NYSE Just Common Stock, which is what most investors use, and it's underneath the moving average, but it did bounce up in Friday's session after declining for a lot of the week. The S&P 500 is coming right back up to its moving average. We're seeing a bit of a bounce with the mid caps as well as the small caps. We also look at the blue line and notice as the market's been under pressure, these lines have also been declining. Then we look at traditional Dow theory. That's in the top, and that was up in Friday's session. And then traditional Dow theory just looks at transports down here, and that bounced up a little bit. I also include utilities. That's kind of my own thing. It depends if you're a true Dow theory purist. You probably just look at the Dow and the transports, where utilities had been under some pressure. They started to bounce back up, and now they're starting to come back down. Then we look at a ratio between the transports and the S&P. When the transports are happy, the S&P tends to be a lot happier. But if you look at this ratio, it's going down. So this is another warning sign for stocks. We look at a ratio between the Dow and the transports. When this is going up, that means the Dow is outperforming, and that's what's been happening lately. And then we look at a correlation between the S&P on top, the transports in the middle, and then the correlation between them. When we're getting a really high reading like this, that means they're going in the same direction at the same time. It doesn't tell us what the direction is. It just says what is the relationship between them with each other. Then here's a new take on Dow theory, where you, instead of using the Dow on top, we look at the S&P. And then we chart this out here, and we have different support and resistance levels. And then instead of using the transports, we use the NASDAQ, which is more tech, and that's more of a representation of the U.S. economy. And what we're looking for here are divergences and convergences. Well, right now, they're pretty much converging with each other. We're not seeing anything really out of the ordinary. They're having a tendency to move in the same direction at the same time. We keep an eye on the FANG index. These are the big companies: Facebook, Amazon, Apple, Netflix, Google, and some other ones. And we are seeing a nice little rebound here. In the past week or so, we've been able to recapture the 50-day moving average and assume this longer-term uptrend. This is another area that's kind of interesting and is pretty positive. I drew a green trend line from this high back down to this other high. Well, we were able to get above that and then close above it, and we're right at 8,000 now with the FANG index. So this is showing some improvement. The next area is going to be, can we get back to this previous area of resistance and then be able to break through that and set a new all-time high? We look at ARK because a lot of people are involved in that. It's been under a lot of pressure going back to 2021, and it's still in a downtrend. It was starting to really bounce back up as the market was bouncing, but this past week didn't really have a good week, and it's still in a death cross. Then we look at the S&P on a monthly chart and compare it with world stocks in Europe, Australia, Asia, and the Far East. When we're above the red line, that means the S&P is outperforming, and the red line is also going up. We're seeing the momentum oscillator down here below. This is the PPO, and we're above zero, and we're continuing to advance. So that means that the S&P is really outperforming the rest of world stocks. We keep an eye on bonds. Here's the total bond ETF, which is in a downtrend based on price. The world bonds are also in a downtrend, even though they bounced back up after coming back down to this previous low. We look at a ratio on a monthly chart between stocks and bonds. When this is really going up the way it is now, that means stocks are outperforming bonds. And this is showing how bonds are underperforming stocks. We look at high yield corporate bonds. These are junk bonds, and they tend to follow the stock market. And as the stock market has been bouncing back up, we're seeing the high yield bonds also starting to go back up, and they're still in a downtrend or in an uptrend, even though this has been weakening lately. Then these are more conservative bonds. They call them investment grade bonds, where they are in a downtrend. And then we look at riskier bonds like junk bonds, and we compare them with more conservative bonds like government bonds, which are assumed to have no risk. And folks are still tending to prefer being in the riskier bonds. They're willing to trade a return or a yield for safety. If they were really worried about safety, they'd be getting into government bonds, but they're not as concerned, so they're getting into the riskier junk bonds. Then we look at some correlations. And when this is giving us a high level, that means they're going in the same direction at the same time. So stocks and bonds, where we look at bonds based on price and stocks based on price, they have a really strong correlated relationship right now. We look at the Dow Jones Corporate Bond Index, which is continuing to be in a downtrend, even though it has been bouncing up lately. Here's the 10-year yield, which got almost up to 5% and then has been falling back down. And then this is a longer-term chart going back to 1980. And I point this out in every week's video, where for 40 years, we saw a series of lower highs and lower lows as interest rates kept coming down, 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 down. We're starting to wonder, are we seeing a big macro shift here where we're going back into a higher interest rate environment? That's what most of history has been. What we've seen over the last 40 years has been the exception. So we're just keeping an eye on this. We won't know the answer to this until we actually look back a little bit further, but we're just keeping an eye on that for now. Here's the 30-year yield, which is not all the way back up to its previous high, and it did drop this past week. And then we look at a ratio between the S&P 500 and the 10-year yield. And when this is going down, that means the S&P is underperforming, but lately the S&P has been outperforming and showing some improvement, but it's still in a longer-term downtrend. This is the junk bond ETF, which continues to be in an uptrend as well. We look at junk bonds and compare them with regular government bonds, and not surprisingly, junk bonds are really outperforming. We look at the 7 to 10-year Treasury bond ETF. This is based on price, where we've been under a lot of pressure. We just generated a recent death cross, but lately we've been seeing a bit of a bounce. The RSI is above 50. We're coming back above the 50-day moving average, and the MACD is also showing positive momentum. Then we look at a daily chart of the different yields at different maturities, where you can kind of see all of these going up over a period of time. Lately, they've been coming back down, and then they started to go back up later on in the week. This is a weekly chart of international rates, where we have in green, that's the US, and we have the highest yield right now, followed by the UK, in blue is Germany, and in red is Japan. We look at the MOVE index, which measures the volatility of bonds, and then the VIX, which measures the volatility of stocks, and we can see on the bottom that they have a pretty strong correlated relationship with each other. This is a monthly chart of the price of the long-term 30-year bond ETF, where it is in a longer-term downtrend and has been in that for, 3 years now. And we can see when we compare the price of bonds to the CRB, even though the CRB has been doing better, bonds still are outperforming the CRB index. This is a monthly chart, so it takes a long time for this to actually switch over. Then we look at different sectors. We compare the materials sector with the S&P 500, and it is underperforming. Also, communication, been one of the stronger areas in 2023. It is outperforming. We look at the energy sector, which was making a roaring comeback, actually enough to give us a golden cross here, but lately we've been seeing a lot of weakness in energy. The financials, we really plummeted when we had the banking crisis back in March, and we've been going sideways and underperforming ever since. And we look at industrials, which are underperforming the S&P. Tech, which has been a stronger area in 2023, it's still in a solid uptrend. Staples have been really underperforming. These are more defensive. These are things that you have to have no matter what's happening in the economy. And so when we're having difficulty in the market, staples tend to do better. When we're in more of a growth environment, that's when staples tend to underperform. Then real estate, which continues to be in a downtrend when you compare it to the S&P. Utilities also in a downtrend. They don't like interest rates going up. And so as interest rates have been going up, utilities have been going down. And then this is a ratio. And the S&P to utilities ratio currently has been going up. And if you look up above, you can see when this ratio is going up, the S&P tends to go up. When this ratio is going down, the S&P tends to go down as well. So we can use this as a confirmation of the direction that we're moving, even though we've been choppy recently. We look at healthcare, another thing that people have to have no matter what's happening economically. It's been really underperforming the S&P. There's another look at healthcare showing that it's in a downtrend. Discretionary, these are things that make life more fun. It's been one of the stronger areas in 2023 until we got into the summer months. We started to see some weakness in August and into September. We need this to come back and start to outperform if things are going to improve, even though it's still in a longer-term uptrend. We look at the staples sector, which is in a downtrend when we look at it all by itself. The tech sector, which is in an uptrend. We look at semiconductors. They made a pretty good roaring comeback. And even though they had been under some weakness, the uptrend seems to be resuming. The tech to S&P 500 ratio shows that tech is really outperforming. Energy, which had been making a comeback when you compare it to tech, is now starting to underperform. So this ratio is going down. We look at growth stocks and compare them to bonds, and it's probably not a surprise. Growth is really outperforming the more conservative bonds. We do a ratio between the tech sector and the 10-year yield, where the tech sector had been starting to underperform enough to give us a death cross here, but lately it's been bouncing back up. Here's an inverse of that same chart where the rise in interest rates was outperforming, but now starting to pull back. We do a ratio between discretionary and staples, where discretionary, even though discretionary has been weak, staples have been even weaker. And so this ratio is still continuing to go higher. Then we look at an inverse, where staples are underperforming discretionary. We look at gold and compare it to the S&P, where when things were getting a little crazy there, and it could always turn crazy again, we saw gold really outperforming the S&P, but now things are settling down a bit on the news emotional cycle, and so we're seeing gold starting to come back down. Then we compare gold to the dollar, where the dollar's been strong, and that has really been outperforming gold, so this ratio is going down. High leverage loans, and I say this every week, if we were getting ready to fall off a cliff, these are not stupid people that get into the BKLN ETF. And if they really knew something was going on, they would not be getting into this ETF. These are risky loans. Would they be in a solid uptrend like they are right now? Probably not. We would see this really start to fall off a cliff, and it's not doing that. The NYSE composite has been chopping sideways, and we've just seen a recent death cross here. That's a broader market measure. When we look at all stocks, not only in the US, but internationally, it had been showing some weakness, but is now starting to bounce back up. We'll see if it's able to recapture the uptrend. Emerging markets, that was all the craze in the beginning of 2023. Then it kind of died away, and now they are in a downtrend. The micro caps, really small companies, they have set a number of new 52-week lows recently. They were looking a little bit better, but then dropped below 100. We're bouncing back up just a little bit here. Didn't set a new 52-week low on Friday, but we want to see some strength here because we can see that there was a death cross in this index. We keep an eye on the home builders. We look for divergences and convergences, not really seeing anything all that much right now because the correlation between the two is still pretty strong. We look at Bitcoin just to keep an eye on that. It's kind of interesting. I'm not involved in any of the crypto markets, but it was enjoying some positive seasonality, and a lot of people knew about that, and maybe it's a self-fulfilling prophecy where we had been in a downtrend, and now we're starting to see an uptrend here, and it got up to 38 and then ended up coming back down into the 36s. Look internationally, and this is a long-term momentum where I use the KST on this chart. China's starting to turn back up. Emerging markets are trying to show some improvement. Europe, as well as Japan and the US. So we tend to see these go more hand in hand with each other. Then we look at an intermarket analysis chart going back to the beginning of the year. The black line are stocks, and they're doing the best. In second place is the dollar, that's green. And third place is gold, that's the gold line. And energy, which had been doing well, has really been under a lot of pressure, even though it's still positive. That's in red, where bonds switched over negative back in August, and they've been underwater ever since. We also keep an eye on some correlations, the S&P to the dollar, where they're having a pretty strong tendency to go in opposite directions. So if you're watching the market and the S&P is up and the dollar's down, or vice versa, that's probably what's happening. Then we look at the correlation between the S&P and oil, and they're still having a pretty strong tendency to go in opposite directions. That's because of what happened that I mentioned earlier with oil going up, more for inflationary reasons, not because of the oil companies are growing. Then we look at the correlation between the S&P and the 10-year yield. They're also having a strong tendency to go in opposite directions. And the tech sector to the 10-year yield, also opposite directions. And then we look at the S&P to the 2-year yield, where they were going in the same direction for quite a while. Now they're starting to go more in the opposite direction. And then some long-term secular, which can be decades, and cyclical trend studies. Cyclical usually means years. This is a monthly chart of the NYSE composite where it's starting to come back above its moving average. So that's turning more positive. We use the Kopic curve down below as a momentum oscillator, and that is still remaining positive, even though it came under some recent pressure. We look at a daily chart of the NYSE composite, and then we look at the NYSE record high percent index, and this is starting to tick back up. It was really negative back in 2022. It was turning more positive in 2023. In the summer and into the fall, when we were under pressure, this was going down, and we'll see if this starts to go back up. We look at the S&P on top. It's still above the moving average. This is also a monthly chart. So this is a long-term momentum chart. And then we look at the PPO, where it's trying to turn back up. It had been stronger in 2023. It went down with the rest of the market, and we'll see if it's starting to improve. Then we look at the S&P 500 on top. This is a daily chart. And then we do a ratio between the S&P 500 and the CRB index. And it shows that stocks are still outperforming the CRB index. We look at the S&P 500 and then a monthly chart of another global index. And the KST is trying to cross over positive, but it's still negative. On top, we're still above an advancing moving average. So longer term, we're still hanging in there positive. Then at the very end, what I do is I list all the positive things and the negative things. My definition of positive is when the 50-period simple moving average is above the 200-day simple moving average. We have the CRB index, the dollar, mega caps, the FANG index, bonds. When you look at just high yield and junk bonds, the tech sector, as well as semiconductors, high leverage loans, the Dow, which is very close to generating a death cross, but not quite there yet. We're above both the 50 and 200-day moving average. We can stay above that. We might avoid that death cross. The NASDAQ and NASDAQ 100, all stocks, both US and internationally, as well as Bitcoin, has now switched over to positive. Then I list all the negative things. And this is when the 50-period simple moving average is below the 200-period simple moving average. We have the growth indexes and ETFs when you look at them by themselves, as well as value indexes. Both are in downtrends. Gold and silver are still in downtrends, even though they've been bouncing up as the geopolitical events have been happening. Copper's in a downtrend. The Japanese yen, the British pound to the US dollar, they are both in downtrends. And the euro, did I mention that there? And the biggest software companies, they're showing some improvement, but they're still in a longer-term downtrend. The Dow Jones Composite Average, the low volatility stocks, ARK is still in a downtrend. The NYSE Composite, Staples, the Total Bond ETF, World Bonds, the mid caps, small caps, and micro caps. So we're seeing the big, large caps doing okay, the Dow, the S&P, and the NASDAQ 100, and even the NASDAQ. But some of the other smaller companies are still really struggling. And then emerging markets are also in a downtrend. And then the investment grade as well as corporate bonds. These are the more conservative bonds. Thank you. I really hope you found this helpful. Please know that I do post a video every day. I also have a weekly video. After this, I'll be doing what I call the deep dive video. I hope you have a great weekend, and I will talk to you in the next video.